The seventh table is assessing fraud risk. What is fraud? In context of auditing financial statements, fraud is defined as intentional misstatements of financial statements. There are two types of fraud. First, fraudulent financial reporting, which is management fraud and misappropriation of assets. Move on to procedures or sources of information to assess fraud risk. First, communications among audit team. This is to share insights or ideas from more experienced audit team members to address the following. First, how and where they believe the entity's financial statement might be susceptible to material misstatement due to fraud, how management could perpetrate and conceal fraudulent financial reporting. Third, how anyone might misappropriate assets of the entity. Fourth, how the auditor might respond to the susceptibility of material misstatement due to fraud. Second, inquiries of management. Auditors should make specific inquiries about fraud with each client in every audit, also about management views of the risk of fraud and about existing programs and controls to address specific identified fraud risks. Third is risk factors. Example of risk factors related to misstatements. A. Incentive or pressure. Excessive pressure exists on management to meet the financial target or financial stability of the company. B. Opportunity. There is insufficient segregation of duties to allow the individual to handle cash receipts related accounting records. C. Attitudes. Promised by management to achieve certain target to analysts, creditors, and other third parties. Fourth, analytical procedures. To help identify any unusual transaction or events that might indicate the presence of material misstatements. Next, analytical procedure results obtained during planning that indicate unexpected analytical relationships. Fifth, other information. Knowledge obtained through other procedures such as client acceptance and retention decisions, interim review of financial statement, and consideration of inherent or control risks. Now, let's move on to responding to fraud risks. Change the overall conduct of the audit. Fraud preparators are often knowledgeable about audit procedures. If the risk of misstatement due to fraud is increased, more experienced personnel may be assigned to the audit. For example, auditors may visit inventory location or test accounts that were not tested in prior periods. Second, design and perform audit procedures to address fraud risks. The appropriate audit procedures used to address specific fraud risks depend on the account being audited and type of fraud risk identified. Example, if concerns are raised above revenue recognition because of cut-off or channel stuffing, the auditor may review the sales channel for unusual activity near the end of the sales period. Third, design and perform procedures to address management override of controls. Auditors are required to take 3 actions to address potential management override of controls. A. Examine journal entries and other adjustments for evidence of possible misstatement due to fraud. B. Review accounting estimates for bias. C. Evaluate the business rationale for significant unusual transactions. Move on to responsibilities when fraud is suspected. When the auditor suspects that fraud may be present, the auditor must obtain additional evidence to determine whether material fraud has occurred. The auditor also must consider the implications of other aspects of the audit. When the auditor determines that fraud may be present, the auditor needs to discuss the matter and audit approach for further investigation with an appropriate level of management that is at least one level above those involved, and with senior management and the audit committee, even if the matter might be considered inconsequential. For public company auditors, the discovery of fraud of any magnitude by senior management is at least a significant deficiency and may be a material weakness in internal control over financial reporting. This includes fraud by senior management that result in even immaterial misstatements. If the public company auditor decides the fraud is a material weakness, the auditor's report on internal control over financial reporting will contain an adverse opinion.
Created using Powtoon.